Hi there, I'm Mark. I'm with Credit Counseling Society. Today we're going to be talking about some home ownership issues. Are you ready to buy? What do you have to do? Who do you have to know? There's a lot of questions around this, and while there's a lot of information that floats around, people aren't generally very fluent with it. I've owned a house for 18 years. I paid my first mortgage off in 10, which was a really good feeling. And then on Monday we moved into our new house and took on a great big mortgage again. So this is all familiar to us. Go and buy, sir. So we're going to look at a whole bunch of things. I'll let you know I have a great deal of experience because not only have I bought and sold several houses, beyond that I've been a senior lender with one of the big banks, and I've done mortgages and pre-approvals, interest rate negotiations, things along that line. I've also been a credit counselor for 5 years where I would go and look at people's mortgage issues and other credit issues and try and help them determine the best ways forward. One of the worst feelings you'll ever have is if your house doesn't go as you plan, foreclosure proceeds. What do you do? What do you do if you have a special assessment and you own a condo? So these are the things we'll sort of talk about and take a quick look at. I'll let you know Credit Counseling Society is a registered charity. We've been around for 20 years. And we've helped almost 500,000 Canadians learn to better budget their money, manage their debts, plan for the future, and move forward in a positive way with their finances. And we do this by providing free and confidential credit counseling, referral services to a whole bunch of different agencies, whether it be a bankruptcy trustee, off to the food bank, Calgary Counseling, whatever people might need. At the end of the day, we've been around for almost 20 years, and we basically help people when they're in credit trouble. If it's not in credit trouble, we help people budget, figure out what money should go where. You know, eating $1,800 of Vietnamese noodles a month is an irrational spend. We remind people that Health Canada says $250 a month is kind of a more normal number to spend on food. Doesn't sound like much, but that's what Health Canada says. So if anyone ever needs help, what I always encourage them to do is to ask for it sooner than later. And if you need to run a budget, we'll help you with that. If you need to reach a social resource, we'll help you with that. If you need help figuring out what to do with debt, that's what we help people with. It's always okay to ask for help. We're free and confidential. You can call the 1-800 number, ask a question, set up an appointment, do a budget, whatever works best for you. So what we're going to talk about today, wants versus needs. This is a big thing when people buy houses, because what we're all going to discover is that everything we want in a house is really expensive. Yes, a 3-bedroom house is nice, but the 4th bedroom costs a lot more money. 2 bathrooms in a house, kind of a normal number, but getting that ensuite is a lot more money. Let's really understand what we want versus what we need, so we have everything that we have to have, and we have some of the things we want, but we don't really pinch our pocketbook to the point where we're uncomfortable. Let's see if we're ready to buy a home. What is all involved? There are things we need before we buy a home, and people forget about them. A down payment's a good place to start, for example. An emergency savings account. Let's talk about financing options. Let's talk about insured mortgages versus uninsured mortgages, and what exactly is involved and the difference between the two. Let's know the difference between going to our bank for financing and going to a mortgage broker. Is there a benefit to either? What do we do if we're self-employed? Is anyone here self-employed?
Have been.
Yeah, it can greatly affect your ability to get a mortgage, and I'll tell you a bit about that. And then let's talk about what actually goes into buying a home, the costs associated with it, the offset cost compared to renting. Most people think buying a home is probably the best way to invest your money. It might be, but it might not be. And I pulled up some numbers today at work just to give you an idea of what you could actually do with the difference between owning and renting. And by the end, you guys will know what you need to buy a house. You'll understand the basic ideas around financing, the rules and the costs, and how exactly that's going to impact you over the long run. And you'll know if you're ready. And that's a big thing. Most people, when they first buy a home, think they're going to eat Kraft dinner and hot dogs for the next 25 years. What I see amongst all my peers who bought homes is that's not in fact the case. It feels really tight for a while, but you grow into it. And people can take comfort in that. People buy homes, people live in them, whether they feel rich or poor. So, when I ask you, what does home ownership give you? What are you looking for in it? What are you trying to fulfill by buying a house? Why are you buying a house?
Or to make your own decisions in your own home.
To decorate it your own way, to maybe knock down a wall, maybe to cut the plumbing on a Sunday afternoon when the babies haven't been bathed, not knowing how to put it back together. I've done that. We didn't have hot water for 2 weeks. That's one thing. A lot of people seek the security though. You know, people buy houses often when they're young. They might be thinking about coupling up, having kids. One of the big reasons I still own a home instead of renting, because I do like the idea of renting, is because my kids can go home every day knowing there's a safe, warm place to be, and they can bring their friends over. And they take a great deal of comfort in that, and I take comfort in that. A lot of people also say they buy it for an investment. Yeah, exactly. And while a lot of people think this is going to boom and explode, and I think maybe we see that more in the Toronto and Vancouver markets, people who've done that in Calgary might not be seeing the same thing. I bought my first house for $160,000. In 3 years, it had gone up to over $400,000. This is not common. And by the time it finished rising, it was probably up around $550,000. Sold it last month for $460,000. The house next door is up for sale for under $400,000. The market's going the wrong way. I remind people when they look at houses for investments, there is an investment to it. You're investing in a place to live for sure, because everyone needs a place to live. But whether or not they retain their value, grow in value, or shrink in value is kind of beyond our power. What I do believe houses are forced savings accounts. Because while you're paying to live there, of course your equity is going to grow to some extent. And when you're done living there, you're going to be able to take a chunk of money out. Whether it's much as we hope for, I don't know. So, we all need shelter. When we think of houses, how much space do we really need? This is a key question when going to purchase. Because more square footage, A, will cost you more money on the purchase, but generally it costs you more money on the maintenance as well. Your roof is bigger. When you re-roof, it's going to cost you more money. You really have to consider this, and consider what you yourself are willing to go without or have to have. I was building a shed on my old house one day about 9 years ago, just knocking nails into wood, no problem, happy day. And these people drive up and they come up to me and they said, "Hey, can we take a look at your house?" A weird request. But they were the people who had it built in 1957. And they said, "We just want to take a look and see how it's changed." Yeah, I'm pretty easygoing. I said, "I'm building a shed. You feel free to go through. There's nothing to steal," because I had an old CRT TV, not a flat screen. We just don't own much stuff. So they walked through and they said, "Oh, it's really, really nice. You guys have done a nice job. How many kids do you have?" "Well, I have 2 small kids." They said, "Yeah, we raised a family of 7 kids in this house. A 3-bedroom, 1,000-square-foot bungalow with an unfinished basement." But when they bought the house, that was a big house for people. And a lot of this consumption around housing is just based on how times have changed. Be wary when you look at a house, get something that fits well, what you're comfortable in. But big house doesn't necessarily mean you're a richer person, right? The next thing is you have to sort of think about, how long do you want your commute to be? If you guys work in Strathmore and you live in Strathmore, I'm going to gather you have a fairly short commute. And this is a nice thing. And it's a nice thing because it gives you more time just on your own, right? You can go do the things you like to do, chase your hobbies, your desires. But it becomes a bigger deal, especially when you start having little kids. Because now, for every minute you're driving to work, it's a minute you're not with the kids. Maybe a minute you're paying for a sitter. It's worth considering in the long run where you want to be. Because when you buy a house, you're probably going to be there for a long time. It's really hard to move. You don't want to move just to accommodate daycare or something like that. So consider your commute. When you're buying a house, I would suggest you want to have a commute of X number of minutes. Why not draw a circle around where you're going and try and find a house in that particular neighborhood, right? What specifically do you want different from what you have now? If you guys are here, you're probably just looking to buy a house, right? So you might not own one currently. Are you living with your parents? No? That's what I want to get away from. Are you living with roommates? Are you living in an apartment? What about where you live now isn't scratching the home itch that you're hoping you'll scratch? It can be a tough thing because it's going to vary for everyone. But when you decide what you don't like about something, you'll have a better idea of what you really do like about something. If your landlord is yelling at you every day about getting FedEx notices on your door, that might be one reason why you want to move. If you have a very small place, maybe you need a bigger place just so that you have a place for your big screen TV. But determine exactly what you're getting away from so you know what you want to move towards. So, are you ready to buy? This is really, really a big question. So, we started by talking about wants versus needs because you need to have realistic expectations. This is really going to fundamentally form the image of the house you have in your head. And I think when we're small, we all want to live in great big castles or we want to live in a cabin in the woods. That's not really realistic. If we're going to live in Strathmore, we're probably going to live in a bungalow, a townhouse, something along those lines. Can you afford what you want? I would love to live in a great big penthouse downtown Calgary. And in fact, I looked at one when I went to buy my new house. It was $399,000. Not bad for 2,400 square feet. The $1,700 condo fees scared me away because those never change. It wasn't a realistic expectation for me because when I retire, I can't pay that in my retirement. Let's make sure that our expectations are realistic so that we know what we're looking for. Do you have your down payment ready? Lots of people who come and see us because they have debt issues come and see us because the debt's not stressing them out. It's the fact they can't buy their house. And if you do have your down payment ready, great. Do you know how to access it? Do you guys have your down payments ready? Because you look pretty flush. No? It's okay if you don't. We're going to talk about the home buyer's plan, where you can draw money from your RSPs, and we'll talk about how you actually make a plan to save money. But a down payment is fundamental before you take the next step. Your down payment, to a large extent, will determine what type of house you can buy, just based on cost factors. Will you qualify for a mortgage? It's a good question. We're going to look at a number of the factors that will help you qualify for a mortgage, including credit score, down payment, ratios, the 5 C's of lending, basically. But once you think you sort of have those things in place, that's when you go talk to your lenders about a pre-approval. And should you use a mortgage broker or should you use a bank? It's up to you. Do you know what it will cost per month to own a home? A lot of people think it just comes down to the mortgage payment. No. It comes down to everything else. Utilities on a house are very expensive. And it's not really how much of the utility you use. A lot of it runs down to transmission of the utilities. I looked at my gas bill because I was moving, so I took a look at it. In August, I paid $7 for natural gas and $42 for transmission of natural gas to my house. Electricity and water are no different. There's a bill there. There's property taxes. There's maintenance. There's when your plumbing backs up on a freezy February and you have to have money to deal with it. We're going to take a quick look at a checklist of things you can expect to overcome. And lastly, do you have a backup plan? And that's the emergency savings. What do you do when something doesn't go right? Because in life, something always doesn't go right. That's Murphy's Law. So let's start by looking at down payments. And if you don't already have a down payment saved, we have to get you on the road to it. And that's why we talk about setting SMART goals. SMART's just an acronym for goal planning. What it means is specific, measurable, achievable, relevant, and timed. Specific means you have to know what you're working towards. So in this case, you're working to buy a house. What's that going to cost you? And yes, it might be a down payment, but it's also the associated fees with getting that house. Lawyers, moving, things along that line. Measurable. This is where we actually get the cost involved. This is how we know when we've got there. We need a hard number. So let's figure out what that hard number is and start working towards it. Achievable. Goals need to be realistic. I know if you want to buy a house, you probably want to do it next week. If you don't have a down payment and you owe $100,000 in credit card debt, it's not going to be next week. Don't set that as a goal because then you're going to give up because you haven't been able to do it. R is relevant. It needs to be important to you. No one works towards a goal if it's not important to them. They give it up right away. So if you don't want to own a house, ultimately you will make your money work to other things that are important to you. And the last one's timed. Timed, without a time limit on achieving something, it's not a goal you're working towards, it's actually a dream. So you need to set a time limit if you're ever going to save up the money to get there. And this is what we like to see people do. We like to see people write down their goals so they can break it down into small saving segments. So here we have, my goal is, I want to achieve it by, it's going to cost me this much money, so this is what I need to save on a regular basis. If we put into action, I want to save for my down payment and achieve it in 3 years, and my down payment is $25,000, we know we have to put aside $321 on a bi-weekly paycheck. What happens if we don't save $321 on a bi-weekly paycheck? It could take longer, right? Maybe we can only save that every other paycheck. Well, it takes us 6 years, right? The thing about houses is there's not a lot of cheating around getting down payments. So you really have to work towards it. What I will tell you around houses, though, it's different from most other goals. Because if you really want it, you'll find a way to save. I see people saving to pay off debt, not super motivating. You don't get a big rush. There's no big, woo, I paid off debt. When you walk through the door of a new house, it's like, yeah, I've done something big with my life. So it's easier to save when you have a really keen goal around a house. And you might set a goal of $321 biweekly. If you really want it, you will find a way to save more. So, to buy a house, we need a mortgage. If you've not had a house before, you may not be very aware of mortgages. But really, a mortgage is a death debt, because originally the idea is it wouldn't get paid out until you died. People live a long time now, so that's not really the case. Most people have the ability to pay off their mortgages inside a 25-year period. So a mortgage is just the debt that is secured by the house you buy. What this means is if you don't pay for the house, you're not paying your mortgage, they come and take it away from you, and that's called a foreclosure. Of all the bankers I've ever met, I've never met one who said, you know what I'm hoping to do today? Foreclose on 10 houses. Banks don't like to own that type of real estate. They will help you as best they can. Keep your house if you're having a hard time, but you will have to ask for help if it's not going very well. When you look around Strathmore though, or when you look around any other city in Canada, you will see lots of people own houses. It's very, very doable. You just have to apply a little bit of discipline. When you go to get a mortgage, there's very specific criteria lenders look for. And this is going to go into the next few segments. But it's good. They're going to look at the insurance. They're going to look for down payments. They're going to look for your ability to pay at the end of the day. So before you go and get a mortgage, you have to have an idea of what you can afford to pay on a monthly basis and how much you can save. Traditionally, your ability to save for a down payment has been an indicator that you can in fact afford to pay the mortgage in an ongoing way. For a little while, mortgages, you could actually put no money down and extend them over 40 years. But about a year or 2 years ago, the government said that's not working because people just walk away from those. So now they've maxed the term out to 25 years. Your mortgage will have to be paid off in 25 years, or else, if you can't afford it over that time, they won't give it to you. This leads us to a down payment. This is what you're going to put down so that the bank knows you have a little bit of skin in the game. And currently, the minimum down payment is around 5% in most circumstances. So think about the house you want to buy. Maybe it's a $500,000 house. I don't know what $500,000 buys in Strathmore. Big house, little house. Good, nice house. Fair enough.
Good size house.
So 5% of $500,000 is $25,000. It's a lot of money. And down payments are hard to come by. But people come by them through a bunch of different means. The first way they do it is they'll sometimes draw from the registered retirement savings. As a first-time home buyer, you're allowed to take as much as $25,000 per first-time home buyer. So if there's two of you buying the house, you'd be allowed $50,000, $25,000 from each RRSP. This isn't money that you could just take and put towards a house, though. The expectation is that you will pay it back over the next 15 years, back into your RRSP. And every year, the government's going to require an installment payment. If you fail to make that payment, they're going to charge you the tax on the money you've borrowed for that year, in addition to whatever other tax they charge you for your paycheck or your income. It's important to remember when you borrow from your RSP, you will have another payment coming out of your budget to pay back into it for a house, okay? Cool. Other ways people get down payments, sometimes they get gifted money from their parents. My parents were in a position where they could give me a little bit of money to get started on that. Sometimes you get a big bonus. I was working as a salesman. I got a $12,000 check. It helped. Sometimes a commission check, sometimes an income tax return. When you go and present your down payment to the bank, or actually apply for the pre-approval, they're going to ask you where that money's coming from. And the reason they ask you for that is because they don't want you buying houses with ill-begotten funds. They're going to want to be able to say, oh, it came from someone's parents. Do we have a check showing that? Oh, it came from a home buyer's plan. Well, that's easy to see. The government released the money. So understand that they're going to want to know where the money came from to make sure it's legitimate. Any questions around down payments? Pretty straightforward? Yeah, it's money you give them so they'll let you buy a house, right? This brings us to the two different types of mortgages. Often first-time home buyers will have what's called a high-ratio mortgage. A high-ratio mortgage is where you put less than 20% of the home's value down. So with houses being as expensive as they are, if you're buying a $500,000 house, very few first-time home buyers have $100,000 to drop and buy it. Well, the banks don't want to take the risk if you don't have some money put down towards the house because it's easy to walk away from. So what they came up with was an idea that insurance companies would ensure that the banks will get their money back. So a high ratio mortgage is where you buy insurance through one of 3 companies in Canada that guarantees that if for whatever reason the house goes into foreclosure, the bank will become whole again, get all its money due back to them. Now, with 5% down, the cost of the insurance is quite high. It's 4% on the remaining balance. So think about that. I'm putting 5% down. So on each $100,000 for that 5% I put down, I'm going to pay $3,800 in insurance. It's a lot of money. And often I'll encourage people to think about trying to save up that money instead. Because if you can save up that money in advance, you put a lot more equity into the home right away, you save the insurance fee, your investment's going to grow faster. But it's not always possible. When you buy this insurance, they'll often just roll it into the mortgage. So it's money they'll lend to you, functionally. But again, remember, it doesn't protect you, it protects the lender. If something untoward should happen, the house goes into foreclosure, the lender will be made whole, and the insurance company will ask for a judgment in place so that they can get all the money that they had to give to the bank back from you after the fact. So I did see a foreclosure where someone was left owing $70,000, not to the bank, because the insurance company paid the bank. They owed $70,000 to the insurance company after the fact. Don't think because you have this insurance you can ever walk away. It doesn't work like that. There are 3 insurance companies in Canada. The big one is Canadian Mortgage and Housing Corporation, CMHC. This is usually the ones the banks default to, in my experience. Genworth used to be part of, I think, General Electric, but sort of spun off, is the other big one. And the last one is Canada Surety. They all do the same thing, they all charge the same rates. What you might want to do is just do some research and see how they've treated their customers who've been in a financial hardship. Because we saw people in Alberta who lost jobs all at once a couple of years ago, and all of a sudden this became an issue. But sometimes some companies will work harder to help remedy the situation than others. So do your research, read reviews, go on Google. When you get your first mortgage, if it's high ratio, they're going to do a stress test to make sure you can continue to pay it even if interest rates rise. And what they do is they run your payment based on the 5-year term. So right now the 5-year term is about 5.5, 5.6%. So when you go to get your mortgage, they're going to calculate the monthly payment you can afford based on that 5.5, 5.6%. But most people don't pay the posted rate. My current mortgage, and I just got it, is at 3.59. It's 2% less than the posted. So if they calculated based on the rate they gave me, I could afford a bigger house, a bigger mortgage. But they build in this little bit of flex in case interest rates go up, so that even as they rise, when it comes time to renew that mortgage, you can still afford to keep that house and keep going. What it means in the short term, though, is you buy less house because your payment has shrunk. Make sense? Okay. Let's talk about conventional mortgages. This is where you have 20% or more to put down against the down payment. And this is hard for people until you've owned a house for a long time, usually, because it takes time to build that equity, right? But if you are in this position, it means you don't have to pay for that insurance. Usually when you own a fifth of a house, the banks are like, no one's going to walk away from a fifth of a house. A $500,000 house, that means you have $100,000 skin in the game. You're going to keep that. You're going to fight for it. You're going to work hard for it. There's still a stress test, though. And here what they do is they look at one of 2 ways to calculate what you can afford. So they take a look to see what your interest rate is and add that the bank is going to give you and add 2 points to it. That way, if interest rates rise by 2%, you can still afford to keep your house at the point of renewal. They also might run the number based on the current benchmark rate, which is 5.34%, I believe, to see, can you keep paying? Either way, because of the new rules, you can afford to buy less house now than you could have 2 years ago. And some people conjecture that that's part of the reason why real estate has gone very soft in some areas. At the end of the day, though, it might help tame you in on some of your wants versus some of your needs when you go to purchase. What I will let you know is that not all lenders are stuck following this rule. It's only the big Canadian banks that are forced into this stress test. If you're a member of a credit union, because they're not regulated by the Federal Office of the Superintendent, but by provincial legislation, they don't have to follow the rules as set out for the big banks. So you may be able to get a bigger mortgage through a credit union or a private lender. Make sure you watch the interest rates and ensure they're competitive. Is anyone here a member of a credit union? And there are credit unions in town. I think you have Chinook Financial. Do you guys have a Mountain View or Service? If you drive into Calgary every day, there's First Calgary. There's a bunch of them. And some people do prefer the credit union system. It's good. They're nice people too. So are the bankers. But if you are committed to having a bigger mortgage, it might be easier through a credit union. When we're qualifying for a mortgage, bankers look at 5 particular things to judge, are you worthy for credit? The first one is character. Have you had a job for a long time? Have you been in the same neighborhood for a long time? You know, is there something on your credit bureau that might make it look like there's something wrong? You know, is there a judgment, something like that pending? Bankers have to trust you to give you a loan. That's fundamentally the first and most important thing. If you come in and I think you're a thief, I'm not going to take the risk on lending you money. If you come in, I've known you for a long time, you've worked at the place down the road, grocery store where I buy my food and I see every week, I feel comfortable with you. Character is a big part of making sure you get a loan. Capacity is important. This is judging, do you have the ability to continually pay the loan? If you have a lot of outstanding debt, you might not be able to pay any more debt. And bankers use 2 ratios to determine, can you afford to keep paying a loan? One's called a gross debt service ratio and one's called a total debt service ratio. Don't worry too much about what they're called or how they're calculated, but I'll let you know that the more debt you have, the less likely you are to get additional lending. Because more debt just means more payments going out the door. Capital refers to the things you own. Banks like to see it when you have lots of assets and very little liabilities. Do you own your pickup truck outright? That's a good thing. Do you have RSPs and savings? That's a good thing. Savers can pay their debt. If you own a lot of new vehicles that are worth less than what you paid for them, because that's how new vehicles work, banks don't like that. If you have a lot of credit card debt, banks don't like that. Let's try and minimize the negatives on our asset list and maximize the positives. Collateral, that's the house itself. Banks will not lend you $500,000 on a $150,000 home. They won't do it because if they have to ever sell that home, they won't get their money back. Banks want to make sure that the value they're giving you matches the house. Man, that makes sense, right? And the last one, conditions. If you work in a mining town and the mine is closing and the banks know, they're not going to lend you money to buy a house there, because the minute they give you that money and you buy that house and everyone finds out that mine is closing, the value of the house drops. Banks need to know that the economic conditions where you're at are positive so that they can expect to get their money back. The other thing banks are going to look at is credit score. And credit score is also a component to getting the insurance. The lowest credit score you can have and still get an insured mortgage is 585. That's considered to be sort of on the poor end of credit scores. Banks don't really like to give uninsured mortgages for under 640, at least when I was a banker. 640 is a good credit score, decent to good. A credit score is just a predictor of how likely are you to pay back the debt in the future. Have you been good at paying back your previous debts? You have a high credit score, low risk, you're probably going to get the loan. If you don't pay your credit back, as you agree, your score will drop, the risk increases. One of the things a credit score is used for is to determine what interest rate you're going to pay on the different debts, including mortgages you have. A low credit score will usually mean a higher interest rate and higher payments. Really good credit scores will bring those interest rates down because there's less risk associated with you. So how do we get a good credit score? The first and most important thing is we have to make our payments on time all the time. Missing payments will bring your score down quickly. The next most important thing is how much do you owe? And this is a two-sided sword. The first thing is, if you have a lot of available credit to you that you can access at any time, they're not going to look at how much you're borrowing right now. They're going to look at how much you can get altogether. $100,000 in credit cards might mean $100,000 less in mortgage because you've already borrowed that money, right? The other thing is, how much of the credit do you utilize? Your credit score will go up when you use less than 50% of the credit limit on your credit cards, on your lines of credit. So if my credit card has a value of $10,000 that I can borrow against, if I go over $5,000, my score starts to drop. So when we're using credit cards, lines of credit, let's understand we never want to go over that 50% mark even for a minute. If I'm going to buy a trip to go to Mexico on that $10,000 credit card, and it's going to cost me $7,500, I'm going to put $2,500 cash down and up to $5,000, but I won't go over $5,000 because I will use too much credit. Length of credit. The longer you've had a particular credit item, the more history the bank can look at to judge whether you're a good bet or not. We do see some kids in college who get a new credit card every time they go to a Flames game and a Stampeders game and wherever else they go. Trading off credit cards like that hurts your score over the long run. The cards aren't in action long enough to really get a good tell. Mature credit is 6 or 7 years old. It's not 2 or 3. So the longer you've had 1 or 2 pieces of credit for a long period of time, the better. Types of credit. Revolving credit is better to have to build a good credit score than just a straight loan. So when you get a loan for a car for $30,000, the first day of that loan, you've used all the credit. The second month of that loan, you used all the credit less one payment. On a 5-year loan, you're over your utilization rate for the first 2.5 years. Really, buying cars will bring your score down over the first half of the loan. It only starts to go up after. Revolving credit, they can see you use it, you pay it back, you use it, you pay it back, use it, you pay it back. It's a better way to build good credit. And the last part is new credit. And this isn't so much about the credit you get, it's about how often do you look to get new credit. Anytime you apply for new credit with a lender, your score goes down a little bit. And there was an incident where a gentleman applied for a car loan on a used car. And he told the credit manager to apply it everywhere. He wanted the best rate. Overnight, he went from a really good credit score to a really bad credit score. He went from a 6% loan to a 30% loan. 2 or 3 times to shop your credit around is fine. So getting a loan, go to RBC, TD, CIBC, but I'm not going out to 100 different lenders because it will hurt me. Okay? Most important thing, make your payments on time, all the time. So, what else goes into a home? Well, you're probably where you have to have mortgage payments, right? And that's usually the single biggest item towards purchasing a home on a monthly basis. In addition to that, there's going to be a whole bunch of other things. House insurance. And house insurance comes with a whole variety of different factors involved. Has there been a flood in your neighborhood? Have you ever made a claim? How old's your roof? How old's your furnace? All these things play a role in it. Most house insurance payments aren't ginormous, but they're worth considering because if you live on a floodplain, it's much more expensive than living on top of the hill above the floodplain because you're likely to get flooded. Property taxes. These are never ending in their rise. Sometimes they hide it from you. You used to get garbage pickup for free in Calgary, and then they started charging you for these different bins outside of your taxes on your NMAX bill. But I'm still paying the garbage tax and my property taxes. Property taxes are always rising. The neighborhood you live in will determine this. How big your house is will determine this. Do you have a garage and the improvements on the property? It sounds trite, but my last house a month ago, $2,400 a year. My new house, $5,000 a year. It's a big shift. It's $200 a month. Utilities. These can be really, really high or really low. The key thing to remember is that a lot of utilities are about the transmission cost, and you can't get out of them anyways. You just have to pay for them. So understand that when you own your own house, you're not just paying electricity, you're probably paying natural gas, water, and sewer. And it's just something you're going to pay on and on and on. Maintenance. If you buy a new house, people think there's no maintenance cost tied to it, but that's in fact not the case. You're going to plant shrubs, flowers, you're going to paint the inside periodically, but the minute you start your mortgage on this brand new house, things start to deteriorate around you. Within 20 years, you'll be looking to put a new roof on. Your appliances are going to go in about 10 years. Your furnace is only going to go 15 to 20 years. At some point, all these things will have to be paid for, and ideally you're setting aside money on a monthly basis to address them as they come up. A new roof can be anywhere from $4,000 to $15,000. You have to have the money ready when you need to have it happen. And the last one are furnishings. Couches don't last forever. I have children. We buy a new couch every 2 years. I don't know what they get on it, but you don't want to sit on it. It just happens. And this, beyond furnishings, you're going to put a new kitchen in at some point or a new bathroom. There's always updates. Let's be aware that these all add up. Some people think you get away from this when you buy a condo or a townhome that has a strata fee included. And to some extent, it can reduce some of the outside costs you're paying. So when you pay your strata fee, it probably includes the outside maintenance. It might include a portion of the homeowner's insurance. So it might be more like you're paying just for the inside insurance of the place you're living in instead of all the outside. It probably includes, the rakes and snow shovels when someone comes and shovels your walk for you. Remember though, it's not free. You're paying for all these things in terms of a condo fee. And you don't have direct control over when the money gets spent. If you are looking to buy a condo or a townhome where there is a strata fee, be aware that you have to investigate the reserve fund. How much money is being set aside for the new roof, the new windows, all the big things that have to happen. If there's not enough money put aside and a major construction incident has to happen, they will assess what's called a special levy against you, where they come door to door and say, oh, the garage is being deemed condemned. We have to put a new one in. We want $100,000 from each homeowner. This is a true story, by the way, because I dealt with that client. And the problem is he didn't have $100,000. So they said, that's okay, you can pay it to us over 2 years. He didn't have $50,000 to pay each of the 2 years. And worse yet, because it was a major part of the structure and it was condemned, the banks weren't going to lend on it. So where's he going to come up with $100,000? You don't have control over these things. You have to make sure that even in the case of having a condo where almost everything is taken care of for you, that you're still putting money aside because there's always that emergency incident. Were you guys aware that there were special assessments that big? I wasn't aware until I took this job and saw a client who'd had $138 special assessment put against him. And he's just like, I don't know what to do. And they do happen. So who's all involved in this and who can help you? Well, the first person you're going to get is a realtor. Do you guys know what realtors cost you when you're buying a house? How much? How much did you have to pay a realtor when you bought your house?
When you're buying?
Yeah.
Nothing.
Nothing. How much do you have to pay when you're selling a house?
A lot.
The standard is about 7% on the first $100,000 and 3% on each $100,000 after that. Now, the nice thing about realtors is they're negotiable. They only get money if they help you, right? So when I bought my first house, I went to my realtor and I said, how much are you giving me back? And she cut me a check for $1,500 after I bought it. This current realtor I used, I said, so you're selling my house, I'm going to let you buy the new one. How much are you cutting me off the sale? I didn't care about buying the house. I needed her to sell the current house. And she didn't want to give me any money. And I said, that's okay, there's 1,000 other realtors out there. She negotiated. Ask them what they're going to give you because it's big bucks. Okay? But they can help you. Realtors are smart people. They know all the other realtors. They can find out some of the good and the bad before you even go into a property. They know about closings. Should you close on the same day? Or should you close on a different day than your sale? Ask them all the questions you need to know because they're very tied in. A mortgage broker is probably the next step. Or your bank. Banks are really good if you have a good relationship with them. And they'll usually give you a pretty competitive rate because all the banks have the same rates. Where I like to see people go to mortgage brokers is when something funny's in the situation. My wife works contract. The bank couldn't include her income, but the mortgage broker could. So we could get a bigger mortgage. Or you're self-employed. The mortgage brokers, because they get paid to place mortgages, will chase you around to get all the right paperwork to get you approved. So there is a benefit to moving with a mortgage broker. They will also usually shop you against a few different institutions to help you get the best rate. Lawyers are pretty big in all this. They're down there. They're ultimately going to transact all the money. So you'll give your realtor a deposit, and then all the rest of the money goes from the mortgage company to the lawyer, to the seller's lawyer, to the seller. You're not even going to touch it. And any shortfalls that he thinks you have to pay, he's going to ask for the money in advance to ensure that the deal closes. Lawyers are smart people. They're going to have you sign a million forms. Listen to them and don't be afraid to ask questions. This might be the only time where a lawyer doesn't charge you hourly, he charges you for the service. How do you find a good lawyer, a good realtor? Ask your friends and family. Do the Google research. And the last one's a home inspector. Anything you fix in a house is super expensive. Even buying a new house, you might want to search for deficiencies. So it's a good idea to go and have someone who's trained as a civil engineer or as an inspector to go and take a look at it for you. They'll usually give you a list of any major requirements that need to be brought up to code, tell you what it would cost to fix them. You can always go back to the seller and ask them to give you the money back on those things. So right here is a list of some of the things you have to consider when buying a house so far as initial payments go. You have your down payment. 5% down on $500,000 is $25,000. Property taxes. You usually don't pay these all up front. You might pay them in installments, either monthly, quarterly, semi-annually, or you might pay them at the end of the year all at once. It's $2,500. It's easier to budget if you pay them on a monthly basis. In Calgary, we have tips. Do you guys have tips here? Where they'll just take the money on a monthly basis, so it's easy to budget. If you don't pay your taxes on time, there is a big penalty for it. I know in Calgary it's about 7%. So you really want to be on top of it. If eventually you don't pay your taxes at all, they will sell your house for you to get their money. It does have to be addressed. The banks are also very keen to make sure it's addressed because the government can supersede their ability to control the property. Transfer taxes. These don't really apply in Alberta. What I will tell you that does apply in Alberta is that when you sell a house, you have to be able to present the real property report. So if you're new buyers, you don't have these, but it's just an outline of what the property looks like, what the physical structures on the property are, where the boundaries are. If you make any changes to the property after you buy it, because they will give you a real property report as part of the sale of the house, you will have to get a new real property report made. So you enlarge the deck by 8 feet, you're required to get a new real property report made. It's about, I think I paid $850. So keep the one you get, file it away safely. You might not have to ever get another one, but if you do need another one, you have to get it before you can sell the property. Realtor fees. Don't worry about that because you're buying. Only sellers pay them. Initial deposits for utilities. If you've never had utilities before, they're going to ask for money to open the accounts. If you're just with one utility provider, it might be as little as $100. If you're with several, it could be $100 each. You'll need that money up front or you won't have power. Inspections. About $500 is right. And when you inspect, you go through with the inspector and he's going to walk you through the different things. You'll spend 4 to 5 hours with him looking at the property if it's big, 2 to 3 if it's smaller. But he'll tell you how old the furnace is and what it costs for a new furnace and how dirty it is and whether it's being looked after. It's worth going in and having it done. Homeowner's insurance. $1,200 is a good number. It can be way higher depending on where you live, but I'd account easily for $100 to $150 a month. And lastly, moving costs. This is expensive and it's hard to manage. When you're buying your first home, you may even do it yourself. Rent a van, load it up with your spouse or your partner or your friends, drive and unload it. When you move to your next house, you will have accumulated all these things in your garage. You may not want to move them, and that's when I tell people to go to Kijiji. People will pick up all sorts of stuff. I had a leather couch that was flaking with holes all over it. Someone begged me to hold it for them so they could come and get it, and they raced down to pick it up. People will take anything. The less you move, the cheaper it is. We can see, though, we might have just expected a $25,000 down payment, and in fact, by the time we take possession of the house, we will have put out almost $40,000. So quick look at inspections. An inspector is going to look at all the different components, the structure, the concrete, the roof, and let you know of major deficiencies. When you're buying your first home, you're not going to have a lot of money to deal with big expenses and surprises. Don't buy a house if you think there might be an issue. This is a cost comparison, renting versus owning. And a lot of people think it's very similar, but the truth is it's not. When we look at all the different things we have to pay for, and we're looking at, this is actually a $700,000 condo out of Langley. It's a real case. And if you want to copy this, I'll send it to you at the end of the day. But we can see that the monthly mortgage payment is substantially higher than just renting the same condo in the same complex. The annual cost of purchasing is $46,000 versus $30,000 renting. And $30,000 to rent is a lot of money. And people often say, well, I don't want to pay someone else's mortgage for them and watch them get rich. But it's not quite as straight lined as that. Because when you own a house, you pay the insurance. And you're probably going to pay a lot more to insure the place that you own than you would pay for tenant insurance. Tenant insurance is probably $15, $20 a month the last time I looked at it. You pay taxes when you own the place. The tenant doesn't. You pay maintenance and upgrades. You might pay the condo fees. When we look at what the total difference is, $57,000 a year to purchase the property on a 25-year mortgage versus $30,500 to rent. And people will say, but it's an investment, because at the end I'm going to be able to sell it and I'll walk away with that money. And it's true. And the nice thing about your primary residence is you don't even pay tax on the money. You sell it, you get to keep all the cash. But I went through a little exercise today. I'm going to refer to these sheets because they're numbers. And what I did was I said, well, what's the difference? What if I took, on a monthly basis, the difference over 25 years between owning and renting? So if I took $2,262 a month and started investing it for 25 years into an RRSP at a 5% interest rate, how much money would I end up with in that RRSP as opposed to owning the house? Any idea how much money I'd have? $1.368 million. And that includes the money you've put in and the 5% compounding interest. Now, I can't tell you what the house is going to be worth, because you bought a $700,000 house and you're living in that house. You're not getting any rent for it. But is it going to go up or down in value? A couple of years ago, I think everyone in Alberta would say real estate only ever goes up. But right now, people in Alberta are saying real estate only seems to be going down. It goes up and down. Houses do generally appreciate in value because there's a cost for the materials. If I went to build the same house today as I did 50 years ago, the materials would cost more. Maybe the land will go up, maybe it won't. But you have to really consider, am I just buying this property as an investment? Because you might do better investing in a different way. Paying rent and investing the difference. And I'll just hand this sheet out to the people here so they can see it's on a Bank of Montreal calculator, so that I wasn't playing with the numbers. Even if I got 3% interest, I'd make over $1 million just saving the difference. We like to see people try things on for size. If you're having a baby, let's try that budget on for size. Let's try and live as though we're only getting EI and like we're not going to work anymore. Let's see how it fits us. We could do the same thing with a house. We just determined that owning a house is more expensive than renting. Let's figure out how much more expensive while we are renting and try and live within our means. So if the house is going to cost us $3,000 a month when we're purchasing and our rent is only $1,500, let's take $1,500 out of our monthly budget for the things we like to do, the coffee, the eating out, the fun, and let's put that in a bank account. And if we can live comfortably, fantastic, we can afford the house. The other benefit is that $1,500 a month we've taken out of our budget now, we can start putting towards a down payment, right? We can start saving it. So we're going to live like we own the house, we're going to be saving money for a down payment, and when we move into the house, we're going to have a more happy comfort level because we demonstrated to ourselves we can do it. If you need help drafting a budget, you can go to mymoneycoach.ca, and there is a budget on there, and there's lots of advice around what different things towards housing costs. And you can sort of have a little play around. But do it for 6 months. And if it is comfortable, you're good to move forward. And you will save a bunch of money. A few other things to consider. Let's go back. Location versus space. It costs a lot of money to live downtown in a major metropolitan center. It doesn't cost much money to live out way in the burbs. but you get a really big house. What's more important to you? You guys live in a less urban center, but I'm sure there's places where people want to live here and places where people don't want to live here. What's more important to you? Figure it out and chase what's important. Don't get distracted by the things that aren't. Understand when you buy a house, there's going to be times when you can't go on a trip because you won't have money. The toilet exploded. You had to get a plumber in. You can't let the water run. Mexico has to wait. Remember, you're working towards something that really is supposed to make you happy in the long run and something that's going to build value over the time. Build that savings account. So when you're ready to give up the house, you'll have a big pocket of change. Get pre-approved for financing. Don't start looking at houses till you know what they'll give you. There's a big disappointment. Have you guys ever seen a show called Property Virgins? And the first thing they do is they walk you down this nice neighborhood. Oh, I'm walking through High Park, looking at these 150-year-old houses in Toronto. They're 3,000 square feet. Yeah, I'd like to live in that one. Well, your budget lets you buy a $150,000 home. How much do you think that one costs? $2.4 million. Well, that's not the house you're getting. Get ready to be disappointed. Know what you can afford, and then set your expectations accordingly. And just because you can afford a big chunk of money, don't feel like you have to spend it. You can buy a smaller house. What if you bought the ugliest house in a neighborhood that you want to be in for the lowest possible price and put a little sweat equity in and built it up and made it your own, but made it really nice? That's another way to build value in real estate, especially if you're handy. I'm not so handy. It didn't work in my case. Remember, it's long-term planning. So don't think you're going to buy a house and flip it and buy a house and flip it. Most people stay for a period of time. You got to be happy. So we have buy only what you need, and that's good advice. Let's not fall into the trap of living in a big fancy neighborhood when that's not what we want or need. You know, big fancy neighborhoods don't let you park your RV out in the front yard. My neighborhood, no one cares because we all have RVs in the front yard. Test drive that mortgage. Take the difference between what it's going to cost to buy and what you're currently paying in rent and put the money aside. Take it out of your budget and start saving it. And remember, all the extra costs are going to add up, and you have to account for them before you move in. It's not just the down payment. It's all the extra things, the legal fees, the utility deposits. And all the tools are at mymoneycoach.ca. We're coming to the end. A few things to consider when getting your first mortgage that isn't in the presentation. The first one is, are you going to have to move sometime while you have the mortgage? In which case, you're going to want to seek a portability clause. That means you can take your mortgage here and move it to a different house of approximately the same value with no penalty. Because paying out mortgages to move is very, very expensive. The other thing is, maybe you're very optimistic about life. I know I'm an optimist. Do you need a prepayment clause? Or maybe when the really good things happen, you can put a lump sum down on the mortgage. Or maybe you can just increase your payments by a little bit. Most mortgages through big financial institutions will offer this, but through smaller lenders, maybe not so much. When you're thinking about buying your house, can you pay an extra payment every year through an accelerated mortgage? This is where we assume that you're getting paid bi-weekly or weekly, and instead of spreading the year out into 12 months, you actually get 2 extra payments on a bi-weekly paycheck system. So what if you paid your mortgage 13 months in a year? On my current mortgage, it takes my mortgage from being a 20-year mortgage to a 17-year mortgage and saves like $45,000. If you can pay accelerated, you'll pay yourself in the long run. Keep looking though. If you need help planning, you can always talk to someone about some budgeting help. You can always go talk to realtors in advance. They're always happy to talk to people and start networking. Talk to your parents and other people who you know have bought homes, and maybe they can give you some advice along the way. I know there's lots of good books on the bookshelves in the library. Don't be afraid to poke around. We've helped almost 500,000 Canadians better budget their money, work with credit issues. If you ever need help, contact us. You can find us on Facebook, Instagram. They make me do the Twitter. I tweet. No one looks at it, but I still do it. We also have a monthly newsletter that has a lot of good points to it. Most importantly, though, we have a 1-888 number. You can always call and ask a question or come in for an appointment just to run a budget. It's free and confidential. Don't ever be afraid to ask because no one knows everything. Does anyone have any questions?
Yeah. you're looking to get some form of income, say like putting in a basement suite into a property or something to that effect, how does that affect getting a mortgage through a lender?
Well, because if the suite's not already, if the suite's not already in the property, they're not going to account any rent to it, right? Because it's not an improvement that's there. There's no anticipated improvement. If there's already a suite in the property, likely what they'll do is, when I was a lender, we would take half the rental amount. So if you assume you're going to get $1,500 a month on it, we would take $750 in income. Now they may ask you to in fact show that you'll have a tenant taking possession as you take possession of the property. But that would be up to the lender. Probably has to do with the down payment you have, your credit score, and a bunch of other factors. Did that answer your question?
Yeah, I think kind of. Another question I had is, like, if a person's looking to actually build a house rather than purchase a pre-existing one, how does that go as far as the whole lending thing? Is that still...
Now, is this in terms of going through so the question is, if we're going to build a house on our own, how do you get the money to build the house on your own?
Yeah.
So if you're going through a big builder, of course you're going to go through a bank and they're going to give you a mortgage for the house you eventually purchase. The money won't be fronted until you take possession. It's almost like buying a used house sort of thing, except you're putting your own stamp on it right away. If you're buying, let's say, land to build a house, they may have different conditions on the amount of down payment required. And what they usually do is they front you portions of the money based on completion. And they're going to have someone go in and appraise the amount of completion you have before they'll front any more money. So there might be a clause saying that before they give you the last chunk of money, that the bathrooms and the kitchen must be completely installed. If the appraiser goes out and says, well, you haven't put in the countertops or the cabinet doors, they will not front you the money. So you really have to be very, very keen in managing the money as it comes in to make sure you're making the required progress.
So essentially you're sitting there in the same circumstances as a contractor would be sitting in.
Yeah, you have to meet the requirements put out by the lender.
Okay.
But there is builder financing available, so people do it. Any other questions?
In the case of if you were to purchase a house on like a lower end, or look at putting money into a renovation right away, is that something that's considered part of a mortgage, or is that a separate type of loan?
Well, usually the mortgage is just for the initial mortgage amount. If you're going to do renovations to upgrade, you could apply for a loan, an improvement loan, but depending on how stretched you are on your dollars, again, it's going to come down to how much more money can they reasonably afford to lend you and still get back. So if you have enough money, yeah, they will give you a loan for it. Often what people will do is, if there's enough equity in the house, so you put like 50% down, they will give you a homeowner's line of credit. And that's up to 65%, generally up to 65% of both the mortgage and the line of credit value combined.
Okay.
Any other questions? Thanks very much, everyone.